my friends, how about we shift gears a bit and kind of turn our attention more on the business side? So we got the COVID stuff. And a lot of this came through. Phase 1, $8.3 billion in emergency. We're going to spend more time on phase 2 and 3 on the business side here. Talked about the payroll tax deferral and the W-2 instructions. All right, the Families First Coronavirus Response Act. Targeted at small business employers, offering things like paid sick leave, paid family medical leave, and to help the employer afford that in the middle of a pandemic, refundable payroll tax credits. Small employer, however, man oh man. Washington, D.C. has a different definition of small than you or me. I see somebody that's got 50, 75, 100 employees. That's a big deal. That's a big company to me. That's a big business. No. Washington, D.C., small potatoes is anybody under 500 employees. And go around, count noses, full-time, part-time, and leased employees. However, you do not count your independent contractors. People under 50 may be exempt from this requirement for financial reasons. So super small or micro employers may be able to get out from under it. The first piece was the emergency paid sick leave. And I want to point out that the law states that employees are legally entitled to this pay. Legally entitled, beginning April 1st through the end of the year. At least that's the eligibility window. Note what happens if your client didn't know it, didn't pay attention to this, or said, F it, I'm not doing it. Okay. That means that a disgruntled employee can call up the blood-sucking lawyer. I can say that as a member of the Michigan Bar Association and a card-carrying attorney. The blood-sucking lawyer, and come after him. In fact, they can get a few employees who were eligible for this to join together. We'll get enough dollars on the table to make it worthwhile. And maybe for some of the larger companies, maybe we'll even see commercials on TV during Jerry Springer and Maury Povich, just like, have you been injured in an auto accident? Call the law, right? Have you been denied? We will get you substantial compensation. That's what happens when you have a legal right that has not been followed. They're entitled to it, people. What are you entitled to? Up to 2 weeks, 80 hours of paid sick leave. How much do you get paid? Well, it depends on what you're out for. Okay? But you are paid at the higher of your normal, regular rate of pay or the minimum wage. And so if you have, for example, workers in the restaurant or hospitality industry who qualify for what is normally a sub-minimum wage because we expect them to get tips, they got to get at least the full minimum wage in your state. How much? Up to $511 a day, their regular rate of pay. Or, you do the math, that's like, how much? $2,500 a week. If I really do the math, it's like anybody earning up to $63 and change an hour gets their full pay. So we're going up to people earning like $120,000 full pay for up to 2 weeks. If they are out for those 2 weeks due to a federal, state, or local quarantine order, You are either testing positive or been in close contact, and you get a quarantine order from the department. If you've been advised to self-quarantine by a healthcare provider, maybe one of your family members or other close contacts has tested positive, or you have symptoms of the COVID and are trying to get a test, get into the doctor and all of that. Now, that's not as big a deal because, you can get on the phone and make an appointment and do the drive-through COVID testing, but even for that, often it's 2 or 3 day wait. And then it's another up to 72 hours to get the results back. So all of a sudden, this is like a week when you probably should not be out running around town, getting into mischief and spreading the wealth. Any of these things, up to 2 weeks of full pay. We cap you out normal, full pay, but capped out at $200 a day, $1,000 a week. How much is that an hour? $200 divided by 8? Yeah, you can do the math. Still pretty good. Still pretty good for a lot of employees. If you did not necessarily get quarantined, but one of your family members did, and you got to care for them. If you have a child whose school or child care is closed, my governor shut ours down the middle of March. Boom! Closed the schools all the way through spring break. And then she decided to keep them closed all the way into June. Now, when your kid is older, that's fine. If you need to run out, go to work, spend a couple hours, the fact that the high school kid or maybe even some of the junior highs are left home alone is okay. But by golly, you got those little rugrats, K through 5, you really can't leave them alone in the house unless you want to visit from family services. Somebody's got to hang out with them. Somebody's got to take care of them. I mean, somebody may not be able to go to work. This is not the employer's problem. It's not the boss's fault. The boss didn't cause this. But the boss is still legally required to provide this pay. They are entitled to it. Don't get pissed off yet. I got an answer coming on that. We'll help you pay for it, okay? Or you have symptoms of a substantially similar as specified by HHS. I haven't heard of any specification of that. If anything, now that the symptoms of what might be COVID are now 90-some items long, which basically means anything. If you're feeling ill, you may got a little gas, indigestion, maybe your sense of smell or taste isn't quite right, anything could be the COVID. So I'm not sure that's all a big deal. But this one, yes?
If I get COVID and get paid my 8 hours,
yeah.
8 months later my kid gets sick, I got to work or I qualify for release, do I get paid another 8 hours?
Well, this one is if you are quarantined, the 2 weeks or 80 hours, I think that's on an employee, not a per incident basis. I think that's the better interpretation. Well, what do you do after the 2 weeks is exhausted? Or you were quarantined for 2 weeks, and now the other household members are, or things like that. That's where we shift into phase 2 of the expanded family medical leave benefit. Now I will give you up to 10 additional weeks when you are unable to work or telework from home while caring for a child whose child care or school is closed. All of a sudden now we've gone from 2 weeks plus 10. We now have up to the full 12 weeks, the normal Family and Medical Leave Act, to work with. Here I'm not getting full pay for the 10 weeks? 2/3 of my normal pay, up to still $200 a day, that's like 25 bucks an hour, or 10 grand total for the 10 weeks. Well, you do the math, to be 2/3 at $1,000 a week, we're really talking about what? People earning how much? About $1,000 a week, $1,500 a week times the 52. Mid-30s, they'll max out. So this is all fine and dandy and wonderful. It really is. It's very cool. How the heck is your client supposed to find the money to pay people out on sick leave for things that are not your client's fault? How the heck are you supposed to pay for that in the middle of a freaking pandemic? What are we going to do for those people? Congress says we will pay for it. The federal government will pay for that. And they will do that by giving your client a fully refundable credit against the payroll taxes that they are supposed to pay on the wages of their employees. It is a dollar-for-dollar credit against the deposits they're supposed to make on the 941s for any qualified sick leave paid. Yeah. And what if you have more people out because our school got closed and I got, 20 of my 30 people are out? The pay you're making is more than the payroll taxes you're going to be withholding and paying for a long time, Mr. Employer. I get it. Well, in that case, it's refundable. You get a check back from the federal government to reimburse your client for the sick pay they've made. Now, non-governmental employers, whether for-profit or tax-exempt, reduce their payroll taxes for all employees by the amount of the credit, and the amount of the credit is the qualified sick pay that they're shelling out. And this is the employer's FICA, the employee's FICA, and the federal income tax withholdings of your employees. All of that your client gets to keep in their pocket, in their checkbook, and pay it to the employees for sick pay. The IRS gave us examples in the instructions to the forms when they came out with the 7200 and tweaking the 941s for this. And so your client shells out for $5,000 of qualified sick pay this payroll period. $5,000. Also included in that and eligible for reimbursement is qualified health care costs. So it's not just the wages. Your client also gets reimbursed for continuing the health insurance premiums for your employees who are out on this kind of sick leave. So you do all of that, and normally, come Friday when the eagle lands and we pay everybody, we owe the federal government $8,000 in payroll taxes and withholdings. That's just normal, every pay period. Well, we get to keep $5,000 in our pocket that we're paying out to the employees. So the deposit within a couple days, EFTPS and all of that crap, is only $3,000. Cool. Effectively, the federal government has reimbursed you for the sick pay that you're shelling out. That's kind of cool. What if that ain't enough? You got a lot of moms and dads who are out because the school or the child care is closed. And you're actually shelling out $10,000 in qualified sick pay and insurance. And You only owe $8,000 in payroll taxes on the pay period. Well, you need to deposit nothing with the federal government. Despite sending out payroll and all the rest, you deposit nothing. And you ask the federal government to send you a check for $2,000. And you do that by preparing and filing Form 7200. This is where you get the advance payment back. This is for those of you who you don't have to wait until your quarterly 941. You can do it on an as-you-go basis. Now, you may make a tactical decision. If you do payroll every week, I don't know if you want to do one of these every week. Look at how much money you got on the table and the time and that and all that. And so maybe you do one every 2 weeks or once a month or whatever it is then in order to get the excess. We're talking cost benefit here in terms of what makes sense for you. Form looks kind of like this. First, tell us about your return. Check the box. Do you file a normal 941 every quarter? Or do you got one of the special ones? Question B is interesting. Is this a new business started on or after January 1 of this year? I think they're a little worried about fraud or abuse, that he's going to claim that he set up this new company, he's now in business, and he gets advance payments refunds for wages that he never paid to imaginary new employees that ought to be coming his direction. Maybe that kind of fraud would be small potatoes next to what we've seen about the PPP loan programs, but I can see it being real. So you can't get the advance payment of it unless and until you file your first quarterly 941 for your new business. Then once you file the 941, you're in the system, we at least think you're semi-legit. Then as you go forward from there, you can ask for the advance payment. So you get down to part 2. What are your total qualified sick wages this quarter? What are your qualified family leave wages this quarter? Okay. Line 2 is the 2 weeks at full pay. Line 3 is the 10 weeks at 2/3 of pay. Total that and the employee retention credit, which comes from the CARES Act. But they've got it on this form now too. All right, what's the total? How much did you reduce your federal deposits already on an as-you-go basis? Remember, they were supposed to, our example, their normal deposits were $8,000 a week. I've done that. Okay. Have I applied for advance payments on other 7200s earlier this quarter? If so, how much have you asked for? So each time you file this, it's a new cumulative calculation. It says, okay. What's the difference? Line 8, how much money are you asking for in a check from the federal government? Tax simplification, this isn't, people. Friday, April 17, they started out with 67 FAQs helping to spell out what this was and how this is supposed to work. I think the list has grown since then. Ain't easy. I don't know about you, but I'm glad I'm not a payroll tax guy. I feel sorry for some of those folks. I hope they're doing this to get the money back for our clients. Then the big kahuna, the CARES Act came. $2 trillion of relief. And yes, we got the all-important PPP loans, the Paycheck Protection Program, some of which may be forgiven. sort of tax-free. Again, that whole IRS thing got in the way. We'll talk about the employee retention credit, which you can also get refunded to you. We saw on line 1 of part 2 of the 7,200, as well as that delay of employer payroll taxes. And then a couple of the pieces we talked about on the individual side, unwrapping and unraveling some of the nastiest problems in the Tax Cut and Jobs Act. So, the infamous PPP loan program. How much money could you get? And really, I think this was intended by Congress as a bridge loan. You know, that this is supposed to bridge you through the shutdown. 2 weeks, 4 weeks, 2 months to flatten the curve, and then we're supposed to get back to business. Was not meant to address, 6, 8 months of shutdowns, second waves, and all of that kind of stuff. How much would the federal government loan you, bridge you? 2.5 months of normal payroll. That's the formula. Average monthly, 2.5, that's what you get. Not to exceed $10 million. So anybody with payroll up to $4 million a month is okay. $1 million a week in total payroll, that's where you hit the $10 million wall. Okay? 2.5 months. The loan was supposed to be brainless for your bank or lender. Why? And because it was 100% fully guaranteed by the federal government. They have it's like having an unlimited personal guarantee signed by the Fed themselves. Your bank can't lose. This explains some of those fraudulent apps going through the way it did, didn't it? Yeah, it does. Banker could lose. Not a problem. And now, and it should have been fast, easy, and painless. Note, the loans were required to be unsecured. The bank could not require or demand collateral or a security agreement. If they did, they were in blatant violation of the law. Same with requiring a personal guarantee from your clients, your business owners. Why? Freaking already have the guarantee of the federal government what's going on. Also understand a few things. For a little more than 10 years in my past life, I practiced business law, 2 different firms. And in one of the things I did for some of that was, clients and buying and selling of businesses and real estate development and all that. Also did bank loan documentation, writing the loan documents and packages and all that, and security for the banks. And can I tell you a couple of things about banks? You know, they love collateral and security agreements and personal guarantees. But even when you pay off that damn loan, did you know that loan is gone and you think the collateral's free? They tend to cross-collateralize those things. And so it secures everything else, including loans they had outstanding before they got that security out of you, as well as money they loaned afterwards. And when it comes to releasing or discharging collateral or guarantees, man, they can't figure out how to do that. Can never find the forms, the paperwork, they can't get it through. It just never happens. Hey, did you refinance your mortgage at any time in the last couple of years? You pay it off, refinance, or whatever? Did you ever get the original mortgage back from your bank that shows it's been paid off, discharged, and recorded with the county? Funny, a lot of the time that just can't happen. It gets lost. That is freaking evil, people. I will tell you that well, we're not going to have them do that. We're not going to let them bootstrap themselves into a security agreement or collateral or a UCC1 on money that they're putting out guaranteed by the federal government, and then they were going to hang on to that. No how, no way. And I know banks really aren't in the business of loaning money anymore. They don't want loans. They don't want interest. They just want fees. You know it. I know it. Well, they were not allowed to charge a fee to your client either. Well, that's okay because they were getting a fee or a commission by the Fed on top of the loan amount, 4% of what they were getting. So they got taken care of pretty dang good. Okay? Now, the loan terms are not all that bad for a bridge loan or an emergency. Up to 10-year maturity. Interest rate can never go over 4%. So think about it. When the pandemic hit, could you go to your bank and get an increase or extension on the line of credit to pull you through? Or no, even when you had a line, they were shutting off, closing out availability, cutting you off, limiting your borrowing amounts. You couldn't get squat. This is effectively a loan for that when the banks were not going to put money out on the street, no matter what your credit record was. Very cool. And for bridge loan terms in the middle of an economic crisis, not bad. Really not bad. Even if you don't get forgiveness, for a bridge loan to keep your company, your business alive and afloat in the middle of a crisis, ain't bad just for what it is. But it gets more gooder. If you spend the money on the right stuff, Congress says, thank you very much. That loan is now forgiven. Cancellation of indebtedness income that the statute says explicitly, yea, even idiot-proof, is tax-free. See, this was really intended, despite in order to get the money out on the street fast, to use all the banks to push the cash out and to process it on behalf of the federal government. Just slam it out there and this is really intended as a government grant. That you pay people, you spend this on payroll, rent on your business facilities, interest on the mortgage on your business facilities, utilities, I mean, all the stuff it takes to keep your business awake and alive and payroll and operating in the middle of a panic. Very cool. This was a government grant to give people the money for that. And it was intended to be a tax-free government grant. And then the IRS got into it and applied that well, what is the worst possible thing for the taxpayer? And they came up with a beauty. They said, well, you can't take tax-free money and pay bills and deduct that on your return. Kind of like taking tax-free, tax-exempt interest income and paying, the interest expense on the loan to carry the municipal bonds. No. So they ruled that when the loan is forgiven, the business expenses you pay are non-deductible. You can't deduct expenses paid with tax-free money. Now, although there's something to that, you gotta get there isn't a point. They got a little something going for them. Riddle me this, Batman. If you would have had, normal expenses and all of that, and you would come out to, let's just say $500,000 income. and you would have gotten the loan from the IRS or from the SBA, and if $1 million, and if Congress would then say you met the terms, they've forgiven it. If they had said that loan, that forgiveness would have been taxable, you would have had your $500,000 in income plus the $1 million forgiveness that would have been taxable. How much are you paying taxes on? 1.5, right? Congress didn't want that. They wanted this a tax-free grant to keep the doors open, to pay people and to pay business expenses during the crisis. They said it's tax-free. So tell me this, how's it work now? The IRS says, okay, you got $500,000 in taxable income, but because you got this $1 million from the government, you have $1 million you cannot deduct. What is my net taxable income now? 1.5. How is that any different than making it taxable forgiveness? And that is exactly what Congress did not want. Oh, some of these days. Now, you've probably heard some of your more prominent Congress people on the news and all talking about how wrong this was and how this completely misconstrues the intent of Congress and all of that. Okay, where's the technical correction? Where's the supplemental legislation? Where have they actually tried to pass anything to fix it? A couple of them sent out a few self-serving press releases, but I ain't seen any action. Have you? No, it all rings a little hollow right now, guys. It does. So, spend the money on the right things. And originally you had to spend the money within 8 weeks of getting your PPP loan funded. Now, if you think about it, payroll and all the rest, the real sweet spot in PPP forgiveness was, remember, the formula was 2.5 months of average payroll. So the sweet spot would have been you keep people going, you pay payroll 2 months, 8 weeks. The sweet spot is if your rent and mortgage interest and utilities and some of that stuff comes out to about half a month of average payroll. That was the sweet spot for the government grant. That was all good and cool until we found out it was not just 2 to 8 weeks to flatten the curve. As the shutdowns and lockdowns and all extended for months and months, 2 months is great, unless the governor won't let your restaurant be open or your office is non-essential or whatever. So Congress has modified the 8 weeks and given you up to 24 weeks from funding to spend money on the right things and to get it tax-free from the government. To get your forgiveness, you need to submit an application to your lender, verifying who you paid, how much, cancel checks for mortgage interest. Oh, why only mortgage interest? If you think of this as a government grant to pay the bills it takes to keep the doors open and to keep your company in business, don't you have to make the whole mortgage payment? If you don't pay the principal, aren't you going to be in default and foreclose? Yeah, of course. I think they were afraid that some smart aleck in the room would take the money and go all Dave Ramsey, and instead of paying people while they're out, for 2 months of pay, that you would take that money and apply it to pay off your mortgage, pay off the principal, get out from under that with the government grant, and then move on from there. Interest only. That's the only way I can make that piece make sense. So we got to have an application for all of this. and documentation, and your banker's going to review it and drag their feet and all of that, because these are loans. Even if it gets forgiven, they do get interest while it's outstanding, don't they? Yep. Clients were advised to segregate those funds and deposit them separately. I don't know how many did. But there's a catch. Oh, yeah. You want free money from Washington? There's a catch. You got to keep people on the payroll, or your debt forgiveness is reduced. Now, if you lay them off, or you don't pay them, or the governor doesn't let you operate, you still get the loan. And it can still help save your business through the middle of this fiasco. But you don't get to keep the money tax-free. It is, in a sense, a bridge loan to get you through that you will have to repay. And that's not all bad, it's just what it is. And forgiveness is reduced if you reduce your workforce during the covered period. This is why you saw businesses holding off, and then we started seeing the layoff notices come, 1st of October and others. Yeah. And then this one popped up earlier this week. Did you? Because they were worried about fraud and abuse and people muscling up to the trough. The SBA had said previously they were going to audit all loans over $2 million. What that audit is, looks like, they hadn't really said yet. They are now reported publicly to be preparing a questionnaire and not only auditing whether you spent the money on the right stuff and whether your documentation was accurate, but also including a loan necessity questionnaire to see whether or not you really needed the money as the COVID hit the fan, and whether you should have borrowed or whether you were being abusive. This is a fine time to tell us about this, people. It really is. So, the PPP loan program, a government grant to help you pay payroll and related essential operating costs, is really cool if your client's business was deemed essential by your governor and your health department, and they were able to stay open and operating and paying people and doing business, even if it was at a reduced level. What if your business was deemed non-essential? So you were shut down. Some of them still are. They still can't get open. What do you do then? Here's where the employee retention credit comes in. Eligible employers, we'll see who that is in a moment, can claim a 1-year credit against the employer's 6.2% of Social Security. 1 year. Now, who's eligible? Anybody whose business was fully or partially suspended during a calendar quarter due to government orders from the governor or the health department. Or you weren't necessarily closed, but you still experienced what they call a significant decline in gross receipts for a quarter. Okay, just like Ed McMahon always said, how big is it, right? How bad must it be? A significant decline in gross receipts is defined as you are less than 50% of last year for the quarter. If your business is down by more than half, you have had a significant decline. Lord help you, and you are eligible for the credit. How long do you get it? Wow. We're actually at the point where the governor's letting us partially reopen. Okay, so what happens? You get back to 52% of gross receipts, 57%? They're still losing money. They're still bleeding. They're not set up to make a profit at 57% of last year's gross. What do you do then? You stay in the program and you stay eligible unless or until your gross receipts exceed 80% of the prior year for that quarter. So we had people who had clearly been eligible for this in the second and the third quarter of this year when our governor had a lot of things shut down real hard. And now they can open at least something, but with limited occupancy and limited use. At this point, our restaurants are allowed to be open up to 50% of capacity, which sounds good until you see the restaurant people on the news saying, okay, yeah, we're allowed 50% occupancy by the tables. Look, we got all these tables, 4 chairs. That's our maximum. You see 4 people at every table in the restaurant? No! Some of them only have 3 people sitting there. Some of them are a couple. Some people are in there at the table all by themselves, only one person. The restaurant managers tell you, even at 50% legal occupancy, they can't get over 35, 36% of normal business, at any time. There's you can't make money at that level. They just can't turn tables enough. They can't do enough. They're still bleeding horribly. So staying in as hopefully we emerge, we move through the phases, we're allowed more operations and more activities and all, we'll be able to do this until we get to 80%. Now, there was an either-or choice right at the get-go. If you went for a PPP loan, bridge loan for 2.5 months of payroll, you are ineligible for the retention credit. Well, hindsight being 20/20 and the shutdown's going a lot longer than we thought, being in the retention credit until I get back to 80% of gross, that could take quarters, that could be years. Some people are having second thoughts. So how much is it? 50% of qualified wages you pay to an employee for the quarter. Up to $10,000 per employee. So effectively, Uncle Sam will reimburse you with a credit for half of pay for the rank and file. You pay people up to 20 grand. Uncle Sam will reimburse you for the first 10. Bring it on. What's qualified depends on how big your client is. If they are 100 or more full-time employees in 2019, pre-pandemic, then qualified wages are limited to what you actually pay your people who are furloughed or on reduced hours in the shutdown. Actual pay. If you're smaller than that, credit, 50%, qualified wages includes all wages you pay to all of your people for each quarter of the decline in revenue. Not bad. Very big. And what's qualified is not only their wages, but also the employer's health insurance premiums and costs paid for those people. We want to keep them employed, and we want to keep them insured in the middle of this fiasco. That's important. So you're getting that. And then we add the ability to delay or defer the employer's 6.2%. This applies to wages paid beginning March 27, which I believe was the signature date of the CARES Act, through the end of this year. And push them out. Put it off. Half of it you don't have to pay till the end of next year, effectively 12/31. And the other end, so it'll be effectively on your fourth quarter, 9/41 next year. And then the other bit the quarter after. Talked about the business expenses and losses. The CARES Act loosening those three. Cool. All right, let's talk a bit about capital asset expensing. You know, once upon a time, we used to teach classes to accountants on tax depreciation, dealing with things like acres and makers and mid-quarter convention and all of that. Not so much. Actually, we have been through, for a number of years, a long-standing shift in U.S. tax policy away from tax depreciation. You know, tax depreciation is really a reflection of the matching principle of accounting, trying to match up the money we spend with the time periods that are benefited. And we imported that from financial accounting into the tax law as a reserve or allowance for wear, tear, obsolescence, and decay. But over time, we've been shifting away from that. Started with Section 179 expensing, small business expensing. Oh, and it was a big deal. Instead of taking depreciation, man, you could write off, what was it, 10, 20 grand? Woo! That was a big deal. We wanted it for small businesses. We didn't want Dow Chemical or General Motors to use that at year end. So if you bought too much stuff, we took it away. Absolutely. Well, over time, Congress keeps raising it and raising it and raising it. 25 grand, 50, 75, 125. It kept going up and up. And we'd raise the phase-out trigger as well. Then periodically, Congress would think the economy needs a certain kick in the pants. So we'd have Section 163K, bonus depreciation, 30, 50%. Now going to 100. We have shifted away from depreciation towards full, outright, and immediate expensing of most capital assets, most capital spending. That is really a profound shift in U.S. tax policy. No, it's not complete, and no, it's not necessarily permanent, but it is a big deal. And that's where we've gone. Okay? Part of that, the TCJA. So when I talk about this, now the class of capital asset expensing, your thought process needs to be first under the IRS capitalization regs. What do you have to capitalize? And understand the cap regs hate repair and maintenance expenses. Their point of view is you pretty much got to capitalize all of that and depreciate it. But once you've gone through the gauntlet of the cap regs, then your thought process becomes, what can I expense? And when you're doing that, do not ignore The all-important elective de minimis rule of the capitalization rates. If you have a written capitalization policy in place for book purposes that you use for financial statement, financial reporting purposes, you can use that for tax purposes and expense anything up to $2,500 for people without audited financial statements, $5,000 for those who are publicly traded or audited. And that is per item or per invoice or per item on the invoice. I have a new favorite restaurant in the Minneapolis airport. Have you been there? It's called Volante. It's right outside gate F16 or G16. I didn't get to go there this time on the way out here because I flew United instead of Delta. But it's right there. And you go in and you sit down. But you don't have to talk to anybody. And you know something? After I've been teaching class all day, I want to sit down and shut up. I don't want to hear my own voice. I don't want to talk to people. And you don't have to, because there, mounted on your table, is a tablet computer. And you wake it up with your finger, and the first thing it asks you is, which flight are you on? Because it will send you updates. It'll tell you things like, we're boarding your flight now. Get your butt here. We're going to leave without you. Or, your flight has been delayed for 45 minutes. Would you like another beverage? It does that. It's great. And then you order with your finger. Do you want food? Do you want drinks? And then there's a place to swipe your credit card right there. And you swipe it. And then it asks you for your email address for your receipt. And you're putting it in. And before you're even done putting in your email address, the waiter or waitress is there with your adult beverage. And then your pocket vibrates with a PDF of the receipt. It is so cool. I love that place. Picture that setup. Tablet, mounting bracket, credit card reader, about $400 per table, per unit. Take 200 of them to fill out your restaurant. You know that is $80,000. Computers, electronics, and accessories. No, it isn't. That is $80,000 of material and supply expense that you deduct as material and supply expense. And none of it goes onto your 4562. It doesn't use up any of your Section 179 allowance. It doesn't help push you over into the phase out. It's material and supply expense. It's even better. If you can get the Geek Squad to bill you separately, send you a separate invoice for setup and installation and wiring and debugging the software and all, another $20,000, $30,000, $40,000, you can expense that too. All of it. It's awesome, people. We need to train our clients on what that is and how to use it. Critically important. Okay. Then, once you figured out what you can expense with the elective de minimis rule, then what can I expense? Section 179, 168K, 100% bonus depreciation. You know, at the end of that, the only thing that you have left for maker's depreciation is the leftovers. And I mean leftovers like some of the stuff in the back of your fridge at home right now. Some of that you can't even feed that to the dog unless you want to have an accident in the corner, man. That's got to be thrown. The leftovers. All the good stuff gets expensed on the spot in the year you place it in service. Critical. Well, the Tax Cut and Jobs Act, Congress doubled 179 expensing, a full $1 million. They didn't double the phase-out trigger. They just bumped it up 2.5. But this is intended to be a permanent tax change. Well, okay. Permanent in tax means until the next major tax act in Congress, and at that point, all bets are off, okay? We'll see. But they meant it. And apparently, Congress was concerned that over time, the insidious effects of inflation would erode the purchasing power of a dollar and cheapen that $1 million write-off. So they indexed it for inflation. For this year, we get to write off $1,040,000 on the spot. Phase out don't start until you buy more than $2,590,000 of eligible property. IRS has announced the number for next year for 21. Okay, we didn't get much of a bump there. 10 grand, $1,050,000. We even came up a little short on the rounding, on the adjustment for the phase out. We only got to $2,620,000. That's there. It's good to know. Problem with Section 179 expensing is you can only deduct it to the extent of your positive taxable income for the year. If you are break even or losing your shirt, that doesn't do you a dang bit of good. And then you're looking at, makers. Okay? Talked about this one. That extending Section 179 to include qualified improvement property. Any improvement to the interior portion of non-residential real estate. Doesn't matter what kind of non-residential it is. It can be restaurant, it can be retail, it can be office, factory, warehouse, whatever. What a great time to remodel and spiff the joint up. How about your firm's offices, okay? Is there anything you need to do? This is great stuff. Absolutely. I should point out that you cannot use, or qualified improvement property does not include expansion or enlargement. It cannot include internal structural work, and elevators and escalators are excluded. In fact, when you look at the tax law, elevators and escalators are always evil. I'm not sure why. There has to be a story there. What did the Otis Elevator Company do to tick off the government? Actually, I've been told it had something to do with investment tax credit scams in the 1970s. Yep. Don't need an arm's length lease with an unrelated third party. Owner-operated, related party leases and all are qualified. $1,040,000 or $1,050,000 in renovations can be expensed. Beats the heck out of leasehold improvements, 39 years for book, 39 for tax, 40 for book, okay? This is worth knowing, people, across the board. And then Congress went beyond that and truly gutted some of the nastiest things that the IRS did to your clients in the cap rates. Oh yeah, when they have the definition of the building and what's got to be capitalized, including building systems and, oh man, nasty. Look what they did here. You spend $200,000 to put a new roof on a building. I'm sorry, that is not repair and maintenance, people. Don't even start it. That is part of the building. 27 and a half or 39 years, do not mess around. But if your building is non-residential, you can Section 179 that new roof. Expense it. All $200,000. You know, it's even better than that. On my little depreciation quiz, I asked about the what? Partial disposition rule of the cap regs. Anybody know what that is? You know how if you can determine the remaining undepreciated cost or basis of the old roof you're tearing off using any reasonable method, you can expense that too. That's probably another $40,000 or $60,000 you can write off. You are writing off more than the $200,000 cost of your new roof. You're probably writing off 120, 130% of what you're spending. How cool is that, people? It's a great time to be people like us, tax jocks. We're awesome. HVAC system. You put in a new furnace, boiler, chiller, 20-ton AC unit on the roof or the cement pad out back. I'm sorry, people. That is not 7-year machinery, equipment, or anything of the sort. That is almost invariably part of the building. 27 and a half or 39 years. Don't mess around. But now, I can 179 that, people. Expense it. And do you think maybe I can do the partial disposition election on what's left of the old furnace, the old 20-ton AC unit, and all the rest? Heck yeah! Security systems. How long do you get between upgrades on your security system? You know, we started out with those big smoky domes in the ceiling, video cameras recording on Betamax tape. And then, you know, they keep getting smaller and smaller and better. We recorded on VHS and then CD, and now it's all digital DVR. Cameras smaller and smaller, gooder and gooder, so now they can record in HD TV and even see in the dark. So that when the stupid drunken criminals break in the night, we can put it on YouTube and laugh at them. How long do you get between upgrades on the security system? Maybe 5 years? We started with the metal keys, and then we got what? The punch codes? Now we got the magnetic stripe. The next thing the managing partner of the firm is talk about is to put the little RFID chip in your shoulder. So that when Doug walks around, you know, if I'm supposed to get in and be able to talk to him, the doors will open up and let me. And if I shouldn't be bothering him, it keeps me locked out. And of course, there'll be an app on the phone so the managing partner can track me and see where I am in the building at all times. A little close to home there, wasn't it? How long do you get between upgrades on the security system? 4, maybe 5 years? I know it is all very expensive and very sophisticated. Computers and cameras and electronics and all the rest, but it is not 5-year property. It's not 7-year miscellaneous makers. Cap rates say it's the building. But if the building is non-residential, I can Section 179 all of those security system upgrades and enhancements and all the rest and take the partial disposition of the stuff that I'm replacing and upgrading. This is powerful, people. And it's something that your clients and your younger staff need to understand and be doing and working, or we're leaving a lot of dollars on the table. Yes, sir. No. His question for our imaginary long-distance friends, Section 179 really couldn't apply to rental activities. Actually, it did. The actual hang-up is that non-corporate lessors can't claim Section 179. So corporate lessors, together with people who build the asset and lease it out, could take Section 179 for rental real estate. The problem came with your partnerships and LLCs, you know, how we usually hold these things, because we want to use the borrowed money for partner basis. they were not allowed to use Section 179. That has not changed. Right. But this is why the qualified improvement property change is so important. Doesn't help us on this stuff. We still lose out there. But on this, those rental real estate owners were locked out of the Section 179 on the non-corporate lessor provision. Going to QIP, 100% bonus, bypasses that and allows them to expense all of that. And so you have put your finger on one block of clients that we need to look hard at this fall and as we go into next year's prep season. Who did we have who would have been 179 eligible on building improvements, 18, 19, and beyond, that we couldn't 179, but now we can QIP that and 100% bonus it? Yeah, critically important. All right. Also, businesses, hotel, motel, bed and breakfast, providing lodging, were not eligible to 179. Now they are. So when the Holiday Inn Express, the Hampton, the Best Western spends money on new beds and dressers, lobby furniture, whatever, they're eligible. How about you, my friend? Been thinking about fixing the place up a bit, doing the whole Airbnb thing, ordering lots of shiny new things from Wayfair.com? And some of that furniture is going to end up in its personal living area. Wink, wink, nudge, nudge. 179, guys. We're expensing it. We're in business. Yeah. QIP, qualified improvement property. Now with the CARES Act fix, yes, I still am and remain Section 179 eligible, but I also have the option of the 100% bonus under Section 168K. I can decide how to play it, what's best for my client this year, this situation, working with their return. Talked about the IRS telling you how to fix this, one of 3 methods. Also, remember that the interest expense limitation, Section 163J, threatened to be really brutal on people in certain businesses, like farmers, because you think about what happens to their income year by year based on crop and commodity prices. Did we have a hard winter, a good spring, too much rain, not enough rain, all of that? Well, the interest expense limitation would have been brutal for agribusiness. And who else has a major problem with interest expense? Real estate interest, right? You look at any real property company, what are the 2 biggest line items on their income statement? Expenses. Interest and real estate taxes, usually. So they were given the option in the law to elect out and to be free of Section 163J and the 30% interest limitation. Okay, that's all well and good, but that was not a freebie election. There was a price to be paid. The price you paid was that you lost, forfeited, or became ineligible for 100% bonus depreciation permanently. Now, it might not have been such a big deal for the farmers. Think real property interests. For a lot of them, if they were big enough and subject to the interest limitation, electing out was a no-brainer. Why? Because how much 3, 5, and 7-year maker stuff did they have? Like, almost nothing, right? Dang near nothing. So, this was no harm, no foul to elect out and to forego bonus depreciation. What do you do? How do you think about that now when you previously made the irrevocable election to elect out? And to forego bonus depreciation, now that Congress has fixed their screw up and retroactively made qualified improvement property and the improvement in the interior portion of non-residential real estate 100% bonus eligible. Don't you just want to shoot yourself on the spot? Or the accountant who told you to make that election out? Yeah, we don't like it when clients go postal on us. Well, the IRS said Rev Proc 2020-25 came out on April 17. If you had a farmer or a real property business that elected out of the interest expense limitation and 100% bonus, and you thought that was irrevocable, you now have an opportunity to go back and reconsider that, redo that, revoke that election out, deal with the interest expense limitation, 50% in 19 and 20, no help on 18, but to do it and to elect and to keep or use 100% bonus in these years. So, I don't know how many of your clients you elected out for, but I think it's worth going back and reevaluating some of those. Truly. Especially for the real property interests. And again, we do this, we may be getting money back, refunds, e-filing the X's. Ah, yes, the luxury auto limitations. What was the IRS definition of a luxury automobile? Something like a stripped out Dodge Neon or some little Kia cheese box. I mean, seriously, the IRS standard was anything that cost more than $16,000 was a pimped out luxury automobile. Give me a break. Come on. You cannot tell me with a straight face that 97 or 98% of all vehicles sold in the North American market are luxury automobiles. I call bull. You know, that's like what, Garrison Keillor and the Prairie Home Companion, Lake Woebegone, where all of the children are above average. It can't be. It just can't be. Congress bumped that up, reset it. And so if you look at the numbers and you work them backwards, you will find that the new definition of a luxury automobile is $50,000. You can buy a $30,000, $40,000, $50,000 automobile, place it in service, and fully depreciate it over your normal 5-year makers without ever running afoul of the luxury auto caps. Just like orange is the new black, 50 grand is the new definition of luxury. Well, now those numbers get a few little inflation adjustments. However, for this year, the IRS did not give us a bump. So no inflation adjustment from 2019 to 2020. All right. Start on this. All right. This is going to be fun. This is 2020. And so I think it's going to be challenging, and you are going to have to learn how to, or relearn how to deduct losses. particularly pass-through, flow-through, and owner-operator losses on your client's returns. And there are a number of hurdles or limitations that you have to get by. You got to have basis. Your basis has to be at risk. We deal with passive activity losses, and then we got the new Section 461L, the $250,000, $500,000 cap on deducting losses. Have you ever done or heard of the Warrior Dash or the Spartan Run or anything like that? It's like a 5K. You know, you go out, you do it, and you run it. But it's not a 5K where you run down the road and all of that and this. It has like military obstacle course stuff in it. You go out and you start running, and you got to climb, go through the mud, there's a lot of mud, and climb over the wall and get to the other side. And then you run a little farther, got to get down on your hands and knees in the mud and crawl under the barbed wire. Do not hunch your back, okay? Believe me. And then finally, at the end, at least in the Warrior Dash, they have a ditch. And the ditch in the bottom of it is on fire. You know that whole thing about Jack be nimble, Jack be quick. This is no time to trip and fall, people. I have no idea how they got lawyers to let them get away with that. It is a gas. I did it a couple years ago with my older son. You know, it was so much fun. Oh man, gotta do it again. That's what deducting business losses are. You have to deal with those obstacles and get over each one in order, in sequence. You can't skip them, you can't cheat, you can't go around, you can't come back for this one later. No. Basis, at risk, active or passive. And then the other, oh yeah. Well, basis is important. The amount of losses you can deduct is limited to your client's basis. Their basis in S-Corp stock and money they have directly loaned to the S-Corp, or to your basis in your partnership interest. Losses that are suspended because you don't have basis are carried forward indefinitely, so long as you and your surviving spouse on a joint return shall live. And if you cannot find or generate basis before the last of you passes away, that beautiful little printout we get from the tax computer, the software about carry forwards to next year, you might as well just take that piece of paper and slide it right into the casket with them. You know, some caskets have that little drawer so you can put things in. You might as well put that tax carry forward schedule right in there and bury it with them, because it expired when they did. Okay? Gone. And then we'll deal with at-risk and passive rules. After 2017, we also had to deal with that Section 461L limitation, which has now been suspended for 18, 19, and 20, back in 21. And then we go forward till we get past those things. When you sell or otherwise dispose of an interest, if you don't have, if it's gone, any losses suspended due to a lack of basis are gone, done. They turn into a pumpkin at the stroke of midnight. That's just wasted. Losses suspended due to a lack of at-risk or that are passive are released and are now deductible. Generally in full, but they may crowd out losses that you had currently in the year that you otherwise would have deducted. So it may not actually get you anything more this year. You may just be trading what's suspended. And then we hit 2020. You know, all that's been kind of vaguely there and interesting, and maybe active versus passive you've paid attention to. But I'm guessing for the last 10 years, most of us haven't thought much about basis unless or until you had a client sell, dispose, or liquidate a business interest. Or unless somebody died and we start thinking about the tax-free step-up. But we generally didn't have a lot of pass-through, flow-through losses coming through on our returns that we had to worry about whether or not anybody had enough basis to deduct. What do you think now? 2020. I'm afraid to think of how bad it is. When you ask your client how things are going, I'm not sure you get a straight answer for how good or bad their operations are. I think the answer you get a lot is the kind of same answer you get from your kid, where you ask him, how are things going in school right now? Oh, it's good. And then you see the report card. Tax time is going to be, and financials are going to be a lot of report cards for your clients. Knowing your client's basis will be critically important in deducting their COVID-19 losses that flow through. And I'm here to tell you, it looks like the IRS is going to be on this issue and looking at it very hard as well. People need this more than we have at any time in the last 10 years. I mean, we've really, since 2008, 9, 10, they've been, marginally profitable. Okay, it wasn't a great recovery, but it was pretty consistent. Now it's important, people. Real important. So on the partnership side first, when did the IRS add that thing to the bottom of the K-1 asking you to, report partner's capital account? Was that like about what, 04, 05? Somewhere around there, I think. And you could do it any one of a number of ways. You could use tax basis. You could check the box and say it was a GAAP. It could be section 704B or other. And what method did you use? If I go through and look at the K-1s in your office, what did you guys default to? I remember my firm, when that came out, no, we did not have a lot of good basis schedules. We didn't. So what do you do? What do you use when you don't know what people's tax basis is? We defaulted to GAAP or book. Because you looked at the financial statement, you found out what owner's equity, partner's equity was in a lump sum, and you said, he's 20%, he's 30%, you're 10%. Boom! That's my number. And we carry forward from them using book numbers. And we kind of like that because that reconciled pretty well to the book balance sheet. That's on Schedule L of the 1065. Is that what you guys did, by and large? Maybe, maybe not. But we've had our alternate, our options, our choice of what to use and to report for a lot of years. Here's a shot of the draft K1 for 2020. And it just says Partners Capital Account Analysis. It doesn't specify which one you may use or must use. Is that book? Is it tax? Is it GAAP? Is it 704 other? What is it? Well, a couple weeks ago they released a draft of the instructions. Now, normally the IRS doesn't announce draft forms. They don't send out a press release every time they post a draft form. In fact, they have part of the IRS website where you go and you just see what's there. This one they announced with a press release. And they highlighted for us that for 2020, you are required to calculate partner capital accounts using the transactional approach for the tax basis method. Apparently there is no choice, no option. You may not use GAAP or book or 704B or anything else in 2020 or beyond. Get with the program appears to be the message. Now, in their press release, the IRS claims that over half of all partnerships already have been reporting on the tax basis. So this should not be a big deal. You know, when I talk to other accountants, and I'm not sure I believe that. I'm not sure we have been doing tax basis capital accounts for the majority of our clients for the last few years. Maybe you have. Maybe your firm has. If so, bless you. You are fortunate, and accountants all over the country are going to be green with envy, lusting after your carry-forward work papers. They will. But a lot of us have a problem here, because we weren't tax basis. And that's what we got to have. How do you report? Here's what they put in the instructions. If you're uncertain how to report an event or trend, you should account for it in a manner consistent with figuring your adjusted basis. See Code Section 705, 722, 733, 742, and the rest. In other words, once again, you people are supposed to know this. This has been part of the tax law for 40, 50 years or more. Go back and look it up, people. Have telling you. Point blank, get with the program. So, have you ever heard of the transactional method or approach? I never did. And hey, can I tell you that I used to moonlight as an adjunct prof for Grand Valley State University, teaching accounting and tax classes in the undergrad and in the master's in tax program. I actually taught partnership tax in the MST program, and I've never heard of the transactional approach or method. It's not, what the IRS has done is they kind of set a couple formal rules and labeled it as such. But this is tax basis capital accounts for your partners. They called it this. Earlier this year, it was about June, they published Notice 2020-43 and kind of telegraphed that they would be requiring tax basis capital accounts and asked for people's input on a couple of questions and things about different methods. In that notice, they said, okay, here's what it is. You increase your capital account by the amount of money and the tax basis of property assets they contribute to the partnership. Net any liabilities that those assets are subject to and or assumed by the partnership. As well as then you increase it by their share of taxable income or gains, and you decrease it by money and the tax basis of property that is distributed to them. And you decrease, net of liabilities, and decrease it by their share of losses, deductions, and all the rest. Okay, that makes sense. There's nothing hard or new or scary there, right? If you are fortunate enough to have used tax basis capital accounts on last year's partnership return. You're home free, people. You're set, you're done, and just keep carrying it forward. You're beautiful. You really are. Nothing to worry about. No change. You're good to go. Gotta love it. If not, you need to determine tax basis capital account balances at the beginning of the year. You're going to be recalculating, reconstructing, recreating that. And the only way I know to do that, if you want to be honest, is to go back to the organization or the formation of that partnership back in 2004. And find out what each partner contributed in exchange for their partnership interest. Did they contribute cash, property, assets, services? What they put in? What liabilities were transferred or assumed? You got to get that, people. And then you need copies of all the K-1s for all the partners for all of the years since 2004 through 2019. And then you got to post all of the income, losses, deductions, distributions, and all of the rest. So, Doug, the senior partner, walks on down to one of them young accountants down there and says, all right, I need you to go back and recompute basic, tax basis capital accounts for this partnership going back to 2004, and don't bill more than an hour to it. Can you tell I've got some scars on my back that haven't healed? I've been told that. Really? Even if your firm has done that partnership return every year since it was formed in 2004, and you haven't changed tax prep software, and your IT geeks have not purged those files from the server, you can go online and and bring them all and print them all. She can't even go back, open up each partnership return and print out the dang K-1s in an hour. Let alone prepare work papers, schedule and post all of that to each partner's capital account balance. What if we can't pull all of those off? We've changed software. Our IT people have, in order to preserve server space, or when we move to the cloud, now we've only got 5 years or 7 years that you can bring up on your computer. You got to, have you been to the bad place? Do you know what bad place is? It's off-site record storage. Oh my gosh, it's dirty, dank, there is mold and mildew there, dust, rats. This big, people, rats this big. It's awful. And although once upon a time, when we empty files, off the shelves and move it off, it's actually, organized and the banker's boxes are labeled and all of that. People have been going there back and forth, digging through stuff, pulling it out, bringing it back to the office, sending it back. It's never refiled correctly or at all. It's a disaster. Some of you, I tend to think it's mostly this group here, are going to be spending a lot of time in the bad place. I'm thinking the fabric face mask may not be enough. You may need either an N95 mask when you're going there, possibly full military gas mask, okay, if you really want to preserve your health. Some of you are going to be going to the bad place. What if Ripley hasn't done their return all the way back to the formation in 2004? You picked them up you won them over from another accountant. You can ask the client for a copy of all of the K-1s.
one.
Yeah, I thought you had all of those. Nope. So you're going to be on the phone begging and groveling to the prior accountant to get copies of all of those. Actually, they have changed accountants 3 times since 2004. You're going to be... We're doomed. We are absolutely doomed. IRS says if you admitted a new partner during the year via a contribution to capital, you show 0 as their beginning capital account balance on the K-1 and then post their contribution and this year's activities. If your newbie got their interest by purchase, exchange, gift, or inheritance, you are directed to enter the transfer or partner's ending tax basis capital account balance as the beginning of year balance for your newbie. So what if you haven't been doing that? Oh boy, and with that, I love that. That's kind of a teaser like they do on the TV or the movies. I think this is a great time for the afternoon break. I'll just let you guys think about that for roughly 10 minutes till we pick it up. The IRS does have a couple shortcuts you may be able to use.